Before we get started, open up the 4-lecture PDF that is on your home page of your Canvas account. You will be using this as I go through the lecture. Lesson 2 deals with analyzing how transactions affect accounts. So we're going to use the transactions from last chapter and we're going to apply them to our T accounts. Each transaction changes the balance of at least 2 accounts. So again, whenever you record a transaction, it has to affect at least 2 accounts. A list of accounts used by a business is called a chart of accounts. If you look, for example, this is Delgado Web Services chart of accounts. It's like a word bank for all their transactions. They just don't make up account titles for every transaction. They use this. You can see there's a chunk of assets. The ones we've taken a look at so far are cash, our accounts receivable, supplies, and prepaid insurance. Then you have your liabilities, which are all of your accounts payable, the people you owe the money to. And then you have your owner's equity section. And we've dealt with just the capital one right now, and we'll add some of the other ones later on. Then you will see later on we'll have revenue and expense accounts. And so again, it's just like in a test when you have a word bank, you will use those words to fill in the blank. You will use these accounts for every one of your transactions. When accounts are analyzed, debits must always equal the credits for each transaction. So whenever you create your accounts with your T accounts or whatever in your journal, your debits must always equal your credits for every transaction. So let's take a look at the first one, and you can do this along with me on your paper. On January 2nd, we received cash from the owner as an investment, $2,000. Whenever there is a transaction, you have to answer 4 questions. Which accounts are affected? In this particular one, we have cash and we have our capital account. How is each account classified? Our cash is an asset. Our capital account is our owner's equity. How is each classification changed? If you look at that, your asset is increased, which is your cash. Your owner's equity is also increased. And then how is each amount entered into our accounts? We'll go through that with our T accounts. Okay, so receive cash from the owner as an investment, $2,000. Our 2 accounts affected, cash and our capital account. And again, feel free to pause this at any time so that you can fill out your papers. Remember how it fills into our accounting equation. Assets on the left side, liabilities and owner's equity on the right. Our accounts are debit and credit, debit on the left, credit on the right. Okay, so our cash account has a normal debit balance. Our capital account has a normal credit balance because it's on the right-hand side of the accounting equation. We increase on the debit, decrease on the credit of cash. We increase on the normal balance of the capital, decrease on the debit side. So if we receive cash from owner as an investment, our cash is going to go up. To make our cash go up, we have to debit it for $2,000. If we receive cash from owner as an investment, our capital account is going to go up. So we are going to credit our capital for $2,000. You will notice right here, our debits equal our credits. So if we were to write it, as you can see right under the transaction, we would be saying we are going to debit cash for $2,000 and credit Michael Delgado Capital for $2,000. And by saying that, we would understand the debit for cash means it's going up. The credit for your capital account also mean that it's going up. So we're not saying cash is going up, capital is going up anymore. We have to use the debits and the credits. So when you are done, this is what your sheet will look like. You're going to have cash on the left side, which means a debit to cash, capital on the right side, which means it's going to be a credit to our capital. So everything I took off of there is just basically in your head, and you don't have to write it on your sheet. Our second transaction paid cash for supplies, $165. Again, in your head, you have to go through the 4 questions. Which accounts are affected? In this account, in this transaction, I should say, cash and supplies are affected. How is each account classified? You have to know the classification of each account so that you will understand the increase and decrease sides. Okay, cash is an asset, supplies is an asset. How is each classification changed? You have an asset that's decreased in cash and you have an asset increased in supplies. How is each amount entered into our accounts? If you look here, our two accounts, supplies and cash, they fall into our accounting equation like this. You can see both assets are on the left side of our accounting equation. Again, as a reminder, our debits and credits are always on the same side. Debits on the left, credits on the right. Since they are both assets, the normal balances are debit. You increase on the normal balance side, you decrease on the opposite side. So to plug the number in the correct place, if we are paying cash for supplies, that means supplies is going up, so therefore we have to debit our supplies. Cash is going down, so therefore we have to credit our cash. If we were to read this, and if you take away everything else that basically is in your head, you will see that it looks like this, and this is what your sheet will look like. We are going to debit supplies for 165, which means it's going to be on the left side, and it's increasing our supplies, and we are crediting cash for 165, which means it's on the right side since it's a credit, and it's decreasing cash. Our next transaction, paid cash for insurance. Again, the 4 questions we ask. What accounts are affected? Cash and prepaid insurance. How is each classified? Each of them are assets. Cash is an asset. Prepaid insurance is an asset. How is each classification changed? Asset is decreased and an asset is increased. And how are they recorded into our T accounts? Okay, so we have our 2 accounts, prepaid insurance and cash. They fall in the accounting equation like this. They're both assets. They're on the left-hand side of the accounting equation. Our debits and credits, always the same. You should get this by now. Since prepaid insurance and cash are both assets, their normal balances are left-hand balances, which is the debit. Increase on the normal balance side, decrease on the opposite side. Increase on the normal balance side, decrease on the opposite. So if we're going to pay cash for insurance, our prepaid insurance is going up, therefore we're going to debit it. Our cash is going down, therefore we are going to credit it. When it's all done, it looks like this right here. We're going to debit prepaid insurance. It's on the left-hand side. It's a debit for $900. Since we are debiting prepaid insurance, which is an asset, that means it's going up. Cash, we are going to credit. Crediting an asset means it's going to go down, so our cash is decreased. So again, we're going to debit prepaid insurance for $900, and we are going to credit cash for $900. January 5th, bought supplies on account from Canon Office Supplies. Again, which accounts are affected? We have supplies, and we have our accounts payable, Canon Office Supplies. How is each account classified? Remember, we need to know the classification so we can figure out the increases and decreases. Supplies is an asset. Your accounts payable, Canon Office Supply, is a liability. How is each one changed? Asset is increased. Your supplies is going up. And your liability, the amount you owe to Canon Office Supplies, is also going up. And then how are each one of these entered into our accounts? So we'll go to our accounts, our T accounts, and we'll list supplies as one account affected. And we said accounts payable, Canon Office Supply, is also affected. Again, this is how it falls in our accounting equation. Remember, supplies is an asset, accounts payable is a liability. Debits and credits, again, always stay the same. Since supplies is an asset, and on the left-hand side of the accounting equation, it has a left-hand balance, which is a debit. So the normal balance for your supplies is debit. Accounts payable, it's on the right-hand side of the accounting equation. It has a right side balance, which is credit. So that is our normal balance. You increase on the normal balance side, you decrease on the opposite side. increase on the normal balance side, decrease on the opposite. Now we can plug in the number. It says bought supplies on account, so our supplies is going up. So therefore, we have to debit our supplies for $220. The amount we owe Canon Office Supplies, which is our accounts payable, is also going up. And so therefore, we have to credit our accounts payable Canon Office Supplies. When we look at it cleaned up, it looks like this. You can see that we've debited supplies. We've made our supplies go up. And we have credited our liability accounts payable by $220, making that account go up. January 9th, you paid cash on account to Canon Office Supplies. Again, we answer the questions. Which accounts are affected? We have cash and our accounts payable, Canon Office Supplies. How is each classified? Cash is an asset. Accounts payable, Canon Office Supplies, is a liability. How are they changed? Our cash is going down, so an asset is decreased. Our liability is also decreased. That is going down for the amount that we've paid. And then how are they plugged into our accounts? So we list our two accounts that are affected, cash and our accounts payable, Canon Office Supplies. They fall into the accounting equation like this. Our debits and credits stay the same side, as always. Cash is an asset, so therefore the normal balance is debit. A Canon Office Supplies, which is our accounts payable, is a liability, so therefore it has a normal credit balance. Increase on the normal balance side, decrease on the opposite. Increase on the normal balance side, decrease on the opposite. So if we're going to plug in the numbers, if we paid cash, cash is going down. Therefore, we are going to credit cash for $100. Our accounts payable, Canon Office Supply, is also going down. So to make that go down, we have to debit it by $100. So when it is cleaned up, your sheet will look like this. We're debiting our accounts payable. You can see that we've debited it over there. So therefore, it has gone down because it's a liability. And we're crediting cash. That means that also goes down. Again, just as a little review here, these are our three separate classifications that we've worked with so far. And the increases and decreases of all their accounts. Our review problem. Next, we're going to take a look at going through this review problem so you can pull up your work together sheet and do it with me. Okay, our first transaction is in the lower right-hand corner. Receive cash from owner as an investment. Again, you're going to list the account titles. So we have cash, and we have John Jensen Capital. If we receive cash, cash is going up. So therefore, we have to debit our cash. Our capital account is also going up. So we have to credit our capital account. The next one, paid cash for supplies. The two accounts affected, cash and supplies. They are both assets. Cash is going down. Supplies is going up. So we'll list our two accounts, supplies and cash. Cash is an asset and our supplies is going up. So therefore we have to debit. That's our normal balance side. Cash is going down. So therefore we have to credit our cash. The third one is bought supplies on account from Supply Depot. Two accounts affected, supplies and our accounts payable, Supply Depot. So we will list those two. Supplies is an asset, accounts payable is a liability. Supplies, since you bought some more, it's going up. Therefore, we will debit supplies. Our accounts payable has a normal credit balance because it's a liability. The amount that we owe Supply Depot is going up, so therefore we will credit that account. Next transaction, paid cash for insurance. The two accounts affected, insurance, prepaid insurance, and our cash. So we will list those two accounts. They are both assets with normal debit balances. Our prepaid insurance, we bought some more insurance, so that's going to go up. We will debit our prepaid insurance. Since we paid cash, cash is going down, so we will credit our cash. The last one is paid cash on account to Supply Depot. 2 accounts affected, cash and our accounts payable for Supply Depot. So we will list those 2 accounts. Accounts payable is a liability with a normal credit balance. And so therefore, to make it go down, we have to debit it. Cash is also going to go down. It's an asset with a normal debit balance. So to make it go down, we have to credit it. Your assignment is from your online book. Under Chapter 2-2, End of Lesson Review, you will do your Audit Your Understanding, the animated activity, and in that one, make sure every time you flip to a new screen, you watch the video that goes along with it. And then Working Papers 2-2, work together and on your own.